So, all right, here we go. All right, so our methodology, it's very simple. What we're trying to do is look for long-term and reliable resources for market information and analysis. We also want to understand the science that they're using behind that analysis. All right, and so the logos on the right-hand side, those are just some of the resources that we have used and pulled from in order to put this together. What we're trying to do is provide you guys with real-world, actual information that doesn't have an agenda. All right. So disclaimers before we go. Nobody can give you perfect advice. All right. Not me, not Andrew, not anybody. If anyone is telling you they can give you perfect advice, run far and fast from them. All right. This is what we're seeing take place. Right. That's what we're presenting to you today. This is what the science has to say. And based on all that above, this is the best advice that we can give you as of today. The picture on the left is going to be the big message. A recession does not equal a housing crisis. All right, what we have here is a health crisis that is creating a financial crisis. All right, so when we talk about the housing issue, the biggest question that I'm getting asked is this going to be 2008, 2009 again? All right, so let's look at that. We've seen a lot of the data already going through this, but back from 08 to 09, there were a lot of causes, but four of the big ones that contributed to this. Lenders were giving loans out that they should not have been. Some of them were predatory, and I'll have Andrew talk about that in a minute. Buyers are making ridiculous purchases, right? If you're a kindergarten teacher and you walk into a loan office and you tell them you make 150 grand and you buy a $6 million home, you're dumb. The end. Sorry, I can't help you. So when we have lenders taking advantage of people being dumb, you have a market that is overbuilt, and you have home equity positions that are next to nothing. We have that neat little nuclear explosion there on the bottom. All right, so let's dig into this. Andrew, if you want to take over here, talk a little bit about the Mortgage Credit Availability Index, talk a little bit about the dip, what was going on in 08, 09 on the lending side, and kind of how that we've transitioned out of that.
Yeah, it's interesting. I got into the mortgage business right about that time. So I lived through that as I was getting into the business right after I left active duty serving in the military. And it was interesting because it just began to show how difficult it is to get a loan, basically. What the credit requirements are, what the lending standards are. And it also ties into the availability of funds and programs. Earlier on this presentation, I talked about how right now, jumbo loans have all but gone away. They haven't gone away, but they're just about gone right now because there's no liquidity for it. You're seeing lenders raise their minimum FICO, credit scores. I didn't mention this earlier, but for those of you guys who are still on the call, please help me spread the word on this. Forbearances. If you're in a forbearance, like basically nobody will lend to you. So be careful if you take a forbearance. If you need a forbearance, if you've been laid off and you can't make your payment, that tool is available to you so that you don't lose your home. I'm not saying not to do that. The temptation though is to go, well, it's there. I might as well take the break and not make payments for a couple of months. Don't do that unless you have to. If you have to, you have to. No, that's okay. Okay. But don't do it out of like, gosh, I don't know how much, how long these cash reserves are going to last me. So let me go ahead and take this forbearance right now, because it will hurt your credit, and most lenders won't lend to you right now. And so that also speaks to a tightening. It also speaks to this Mortgage Credit Availability Index where as things start happening to people's credit, which is more of a symptom of the underlying economic conditions, right? We had the same problem in the Great Recession. People were losing their jobs. They had acquired massive amounts of debt because rates were so low. They could get easy financing, easy loans for toy haulers and motorcycles and RVs or whatever, right? So people acquired all kinds of consumer debt. And then all of a sudden it came time to make those payments and they really couldn't, whether it was on their mortgages from shady loans that were made. And so what started off as a glut of easy money led to this massive hangover, right? Where people couldn't actually make their payments. And that then begins to impact people's credit scores, their debt to income ratios, their cash flow. And so then things start to show up. on credit in general, and lenders become nervous to lend. So right now, lenders are nervous to lend because they loan to somebody who may be furloughed. They don't know if their job's even ever coming back. Like, if I give this guy a loan, I mean, this is a real simple question. If I give this guy a loan, can he pay me back? It's really the question. So this mortgage credit availability index speaks to the availability of money based on either loosening or tightening of credit guidelines and things like that. So as you can see, in the mid 2000s, it went so high because if you had a pulse, you got a loan. There was no standard in lending. Like, it was like, if you can fog a mirror, you can get a loan for $1 million and no money down, and we don't care if you've got a job. Which led to obviously a tightening, and the graph isn't super expanded, but I can tell you, if you look on that low end there where it says like looks to be about 100 on the low end of the graph there, that's when credit standards were really tight, as a knee-jerk reaction, swinging back the other way from loosey-goosey, get a loan for whatever. It only went up to, like, say 200. There's been a lot of really loose changes that have happened in that time frame. That scale, it doesn't almost look like very much because we're accounting for this time period back in the 2000s. And then the blip down to today, it looks so small on this graph, but I can tell you there's been some real impactful changes in the last month with credit scores and things like that. So anyway, if you can keep, I will tell you this, if you're listening to this now live or afterwards, if you've got reserves, if you've saved and you've got financial reserves, and you can make your payments even while you're between jobs, or maybe just temporarily laid off and your job will come back, you can make your payments right now. If you can hold on and maintain good credit, there's going to be a lot of people who can't, unfortunately, and their credit's going to take a ding. There will be some impact to housing as a result of this in the economy. There will be an impact. Ryan just went through all of that. And in that time period, there's going to be some opportunities. Be the one who's preserved their credit and their cash and has the opportunity to go in and buy that investment property or that second home, while everybody else is salivating on the sidelines, wishing they could be in the game. You could maybe be in the game. I'm going to tell you, that's my plan personally. So.
Yep. I love it. All right, next one coming through, percentage of median income needed to purchase a median priced home. 2006, it basically would cost somebody a quarter of their income. Today, we're at 14.8%. All right, so Andrew, I don't know if you want to talk about that with debt to income, or if you have anything to add.
Yeah, I'm not as familiar with this particular chart, but I think, this is, I would just say that lately, especially in Southern California, you got to, I don't know if this is specific to San Diego or if this is nationwide statistic.
National.
Okay, yeah, because the thing is that here in Southern California, home prices are high. And in reality, what I've seen is that what I look at is what's called the Affordability Index. And it's basically what percentage of people, with median income can buy the median priced home. And that's essentially what this is the Affordability Index. Yep. And that Affordability Index is been getting worse and worse, particularly here in Southern California, where homes and land is at a premium, and we're out of land here, and so we're all built out in San Diego. So supply has got it's curved off here, where it's not like you go out to the Midwest, you go to Texas, Oklahoma, wherever, home prices have a really strong headwind that they run into. And that headwind is that there's so much land, builders just keep building more properties. So the supply you're competing with the new amount of supply that keeps coming to market. Here in Southern California, not so much. I mean, there are new home tracts out there, but I mean, you can practically count them on one hand, and for the most part, any new builds are scraping a house and putting two where one used to be. That, that's adding a couple of units. That's not adding 10,000 units like was what happened. There are home builders in Texas and Oklahoma that are building 10,000 homes a year. I mean, you want to talk about adding to the supply. We don't have that here in San Diego. What that means is that your investment or your purchase here is probably going to be relatively stable in terms of cost, because it's fundamental of economics, supply and demand. The demand may shift. the supply in San Diego and Southern California, it's going to be pretty much what it is, you know. The demand may ebb and flow with economic conditions, people getting their jobs or whatever. So that's something that's kind of unique about where we live here in Southern California, which provides a really good opportunity.
Yeah, no, for sure, for sure. All right, let's keep moving. All right, so I said we're going to come back to months worth of inventory. This is a national graph. Let's start off there. So, all right, months worth of inventory is used to determine the health of a market. Right. So 6 months of inventory. So months of inventory. If we stop taking new listings today, divided the amount of time it takes to sell into it, that's months worth of inventory to sell them out. Okay. 6 months is considered to be a normal, healthy market. 7 months of inventory is a buyer's market. The slide here is saying 6 months. I would say in San Diego, is 4 months worth of inventory puts us into a seller's market. All right. So if we take a look at what was happening in 06 to call it 2012, we see that it was a buyer's market. We had a lot of homes for sale. We were overbuilt. If we look where we are today, we don't have that problem, right? So if we take a look at the graph that's coming in, 8.2 months was what we had in 2007. Today in San Diego County, 1.8 months worth of inventory, right? Very, very different situation than what we had in 2008. All right. From here, Andrew was talking a little bit about this with the total equity cash out. All right. And so 2 charts. The one on the left is from 2005 to 2007, where Americans basically cashed out around $824 billion of their equity to fund their lifestyle. They're buying the toy hauler or the new car or the second home, whatever it was. All right. $824 billion. In the last 3 years, 2017 to 2019, that number's down to $232 billion. So that's $500 billion ish less, right? 600 because my math is bad, apparently. Americans learn their lesson. They learn their lesson. Their house is not their piggy bank, right? And so, Andrew, is there anything you want to add to this? You were talking about it a little bit before. These are just the actual numbers.
No, I mean, it does speak though to, the chart a few slides back where the mortgage credit availability index was higher, meaning that the standards for lending were lower and allowed people to pull out all kinds of money, which led to this crash, which created this instability. Mm-hmm. Lending guidelines changed to protect our collective economy. And that's why I think, even though home values have gone up so much, that's why you see so much less cash coming out. Lending guidelines have muted that to a point where people can take a little bit less out. By the way, that's probably a healthy thing,
Mm-hmm. Yeah, absolutely. All right. So here's a quote. This is with the chief economist with CoreLogic. He came out and said, our home equity report found that at the start of 2020, homeowners with a mortgage had an average of $177,000 worth of equity in their home. That is a tremendously different position than we were in 2008. Right? And so let me put it to you this way. If you own $177,000 in equity in your home and the housing market does do what it did in 2008, but let's say it takes a 25% hit instead of a 20% hit. Your 177 just went to, I believe it's 126,000. Are you walking away from that? Don't think so, right? People aren't going to walk away from their homes like they did previously, right? So we're laying out the evidence. We're laying out the science behind what's different right now than what we had in 2008, right? And so here's a little bit more on mortgages. 53.8% of the homes in the U.S. have at least 50% equity. That's a big number, right? 37% of the homes in the United States are owned outright. There's no mortgage. 26.7% of the homes that do have a mortgage have at least 50% equity. That is a tremendously different position than we were in 2008 when we had a really big housing problem, right? From there, we want to talk about home appreciation, right? If we look at the bar graph on the left with the red, that's the 6 years leading into 2006, right? So 2000 to 2005. You can see the appreciation, 12.5% appreciation, right? It was out of control. There was, and it's overbuilt. If we look at the version on the right, which is the last 6 years leading into 2020, we see a very different story, right? And if we take the best year out of our last 6, 2017, that's not even high enough to displace one of the earlier ones. 6.4, the lowest one that we saw there was in 01 at 6.5%, right? So when we talk about equity in a home, and when we talk about appreciation rates being under control, These are two very, very different situations than where we were at in 2008. From there, what about home pricing during recessions, right? In the last 5 recessions, 3 of them had appreciation, 2 had depreciation, right? So in 1980, we were up 6.1, in 81, we were up 3.5%. 1991, that was the Gulf War recession, we dropped 2%. 2001, that was right around the dot-com crash, September 11th, we increased 6.6%, and then we have the big scary number of 20% down in 2008, right? The housing market led the way to that financial crisis, to the recession. That was the housing market, right? When we look at the projections of what's coming up in our future, right? The projections pre-COVID was a 4.7% appreciation in 2020. They've now downgraded that to 3%. Not good, not terrible. 2021 was projected at 3.8. It's now projected at 4.2. There you go. 2022, there were no projections pre-COVID. Now they're projecting it at 4.6. All right, so that's what the science is having to say. All right, this is the best that anybody can give you. All right, so based on what we know, based on what we see, and based on what the science says, we have fewer homes for sale. Appreciation rates are under control. People have a tremendous amount of home equity. Andrew's spoken very well about the mortgages and what's going on there, and the home value prediction. Right, so there's a lot of people. I got this question a couple times on social media and through some other email channels. Are we looking at 2008 again? This is why I don't think we are. Right, the position that the housing market is in today is in a very, very different position than it was in 2008. The position that the housing market was in leading into the coronavirus recession was very, very different than where it was leading into the early 2000s. All right, so based on that, I think the housing market is actually positioned to lead the way out of the recession. That's a big difference. That's a big, huge difference for homeowners and for people that are looking to buy. All right. So this is the last quote that we have. This is from Goldman Sachs. If policymakers manage to thread the needle between continued virus control and gradual reopening of the economy, the level of GDP should begin to move higher in the months ahead. If you've never tried threading a needle, go give that a shot. And then let me know whether you think the federal government, the state government, and the local governments are capable of doing that exceptionally well. All right. So what does this mean? This is challenging, right? There are 2 competing forces. We have public health and public safety, which I believe everybody takes seriously. We have the entire economy. If those are 2 out of balance, we have a problem. Right? If we continue to have this economy shut down, like the World Health Organization is saying, for the next 18 months, good luck. There will be nothing left. Right? So that's basically where we're at. We know that things are starting to open up in the economy. Whether you're here in California, we're seeing this a little bit. People can go out and run on the trails again. Andrew, I'm sure that's making you happy. I know Christy's very happy about that. The beaches are closed though, right? Still can't go there. My kid can't go play on the playground. Right. So this is changing day by day. What we're going to do is try to provide as much valuable, honest, reliable info as possible for you guys. All right. That is the full housing market update. That is national across the country. Digging a little bit into San Diego, you're going to want to definitely check out the very first short breakout video that gets specifically into the San Diego market. Anyways, this is part of the longer This Week in Housing episode. If you guys want to watch either the full-length video or some other breakout clips like this, the YouTube channel link is right there. If you have more questions specifically about your circumstance or situation, and you want to get in touch with either Andrew or I, all the contact info is there. If you want to simply go to my calendar, select a day and a time for us to get on Zoom and dig into this, the tinyurl.com link is the one to go with. Thank you for watching and have a great day.